Hello, everyone. Hey, I want to thank you guys for taking time to increase your knowledge on the FHA program. As you know, this is one of the best solid lending programs available out in the marketplace today. I'm joined today by Carla Ferguson.
Hello, everyone.
We're going to take the time today to go through and discuss FHA, how the program operates, how they calculate some of their insurance, some of the underwriting aspects, some of the positive attributes of the program, as well as some of the pitfalls that you want to be careful of. This is not an all-inclusive FHA program, but it will cover probably 20–30% of what you need to know, and obviously we will continue to refer you back to the mortgagee letters, the 4155, and other important data that comes out between us and HUD.
At the end of this presentation, there will be a brief opportunity for you to test yourself, test your knowledge as to what information you were able to glean and gain from today's webinar presentation. We highly recommend that you go ahead and take that test and really show how much you're going to excel and gain from this loan product.
And besides that, once you pass that test, you will get a certificate of completion from us that you can proudly display to all of your clients, letting them know that you have upped the bar and that much more of a professional in this environment. Knowledge is power. The FHA program is constantly changing. So again, the information that you're listening to today is to assist you in understanding the program, but it is your responsibility to stay informed of the ongoing changes as they're available through a lot of different websites and material, including the 4155 mortgagee letters and obviously, like I mentioned before, bulletins provided by us.
Now, as far as getting connected, if you're hearing us, then everything is just fine. But if you're experiencing any difficulties whatsoever, please contact our MWF webinar team at webinars@mwfinc.com.
We're leaving that on there for just a second. Of course, you'll hear us state this time and time again throughout this presentation. One of your best tools, your Bible, so to speak, something that you should always have by your side and know where to look up pertinent information regarding this program, is in your 4155. And that's available online, and a lot of folks have printed ones that also they keep. I know our underwriters, when they're looking at files, keep that on their desk ready to go.
So why do you want to do FHA loans? Well, we can tell you a myriad of reasons why this is such a wonderful product. First of all, you have low down payments with high loan-to-value ratios. Cash out refinance transactions, you can go up to 85% LTV. The total down payment may consist of a gift. Rate and term refinances are allowed. You can have those above purchase LTVs, many cases as high as 97.75%. Here it says there are no credit score requirements. That still remains with HUD. However, Mountain West Financial, we do require a minimum of 620 FICO score. Condos now have to have upfront MIP. There are no income limits or sales price restrictions, and the FHA loan is fully assumable.
Now, just to go back on the income limits and sales price restrictions, obviously FHA doesn't, but a lot of times we combine those with down payment assistance programs and MCCs and some other programs that are income restricted. So always know whatever programs you're pairing up together, you're going to go by the income restrictions of the most restrictive of those programs. Seller concessions as high as 6%. That's today. Depending on when you're listening to this webinar, it's quite possible that they will have lowered it to 3%. So keep in mind that that's a time-sensitive instrument that is currently being reviewed by HUD. Non-occupying co-borrowers are allowed with blended ratios, single-family only. Now, one other thing, again, HUD does not actually have a DTI requirement on that, but Mountain West has an overlay that the owner-occupant borrower, their PITI cannot exceed 100% of their gross earnings per month. We feel if it's above that, it becomes a non-owner occupied loan. But again, that's a Mountain West Financial view of a credit risk on a file, not necessarily held by HUD. There is no required cash reserves. as you see at the bottom of the screen, that's for 1 and 2 units only. If you're doing multiple units, 3 or 4, you do have to have at least 3 months PITI in reserves. But also you'll see as you're working in the FHA scorecards for either DU or LP, you'll notice a lot of times cash reserves sure helps you bring those ratios up. So it's really looked at strongly, not only by the scorecard, the computerized automated underwriting, but also by our underwriters as well. Non-taxable income can be grossed up. Borrowers may be able to do a streamlined refinance, and Carla's going to touch base on that in a little bit. And the maximum loan amounts do vary per the county, and that's available on the website. And we'll give you some of those tools at the end of this program so you know where to look up on some of that stuff.
Now, a few things we would like you to be aware of. HUD generally will not insure more than one mortgage for any borrower unless one of these 4 exceptions is in play. The borrower is relocating beyond a reasonable commute. An example of that would be, they're currently living in Northern California, transferring to Southern California or out of state, such as to Arizona, etc. If the borrower is vacating a jointly owned property and the other party will remain as an owner-occupant, then that party may be eligible for another FHA loan. If the borrower will be a non-occupying co-borrower, such as, the mom and dad already have their own FHA loan, and they're going to be a non-occupying co-borrower to the son who is now applying for an FHA loan. Or the borrower's number of legal dependents has increased. This would have to be documented, and the current mortgage is paid down to 75% LTV or less. Borrowers could qualify for a second FHA transaction.
Always has to be that word legal in there, huh?
Legal, yes. Now, we're going to direct you to the handout that was emailed to you. If you are in need of it, please, once again, contact our webinar team. But we're going to go through a lot of the basics as far as FHA financing is concerned.
For those of you that are not listening to this live, but it is recorded, the handout is available also on our website, and I suggest you print that out. So we're going to start with just some basic items. Again, we've talked about the 4155.1. It's online handbook, a very, very handy tool. Benefits of using an FHA loan, as we've discussed. So let's talk about closing costs a little bit. FHA, the origination fee, no longer limits the origination fee to 1% of the mortgage amount for its standard programs. You need to be careful because there are a couple programs out there that's not the case, but for our 203B, which is what we're going to be talking about mostly today, that's the case. Closing costs must be fair and reasonable. However, the 1% origination fee still does apply to your 203K and 203K streamline loans.
And the 203K loan is a rehabilitation mortgage. We do those transactions here at Mountain West Financial.
Of course we do. Not allowable, tax service fee. So according to mortgage letter back in 2006, that's not allowed there. So Mountain West does not charge a tax service fee on those on FHA loans. Seller, like I mentioned, can pay up to 6%. Again, that's time sensitive. There's a chance at some point that that'll be 3%. And that can be used for non-recurring closing costs, prepaids, or to buy down your interest rate temporarily or full-time. Inducements to purchase will affect the sales price. And again, we're going to refer you to a book, page, chapter, and verse of the 4155 for a lot of these things. Inducements to purchase are things like decorating allowance, repair allowance, moving costs, anything over the 6%. But when you see anytime the borrower is going to get cash back at closing to do something after closing, typically that's going to be considered an inducement to purchase, and there will be a dollar reduction off the loan amount. The underwriter must consider a minimum of 15 days of new interest when figuring cash to close.
Now, the upfront mortgage insurance, it has to be either all paid in cash or all financed. And actually, we have a little typographical error there because currently it's at 1.75% of the base loan amount. That has just gone into effect. So 1.75%, please make a note of that. Allowable non-recurring closing costs and prepaids may be paid with premium pricing, which this would be included in the 6% contribution limitation that's there. Credit needs to be itemized. It can't be lumped together. Premium pricing cannot be used to pay off debt.
What?
No, it cannot, Gary. And transaction types that are available, you can do a purchase. We can do streamlined refinances without appraisals. HUD no longer allows a streamline to be done with an appraisal. A streamlined refi is going to be an FHA to an FHA transaction. No cash back is allowed except $500. That's to allow for minor adjustments. And it's really limited qualifying. Now, you may not add closing costs on your streamline, no discount, prepaid items, or any other financing costs to the new loan balance. And we'll cite the mortgagee letter there, 2011-10. You can only increase the insurable balance beyond the sum of what's outstanding by the amount of the new upfront MIP. You can only do that to go over that using a credit qualifying refinance, which would entail having an appraisal. It can be used by investors and non-owner occupant borrowers, and streamlined refinances, once again without appraisals, is the remaining term of the existing mortgage plus 12 years, not to exceed 30 years. Now, don't know how HUD came up with that, but that's the rule.
And just to make it one more complication, we're going to round that off to the nearest 5 years. So
Correct.
You won't be able to get like a 26 or 18-and-a-half-year mortgage. So I think most of us went through a change where we have to realize that the borrower has to receive a net tangible benefit, and this is carved in stone, so there's no variables or variance to this. The originator must determine that the net tangible benefit to the borrower as a result of the streamline without an appraisal has to be at least a 5% reduction in the principal and interest of the mortgage payment plus the annual MIP, or depending if you're doing a different loan like refinancing from an adjustable rate mortgage to a fixed rate loan, then it varies and it shows if it's a fixed to a 1-year ARD or fixed to a hybrid, what the difference is. Because in some cases, you don't have to have that 5% because you're improving the loan type that the borrower has. So this is a good chart for you to go back and refer to when you're talking to somebody that currently has other than a fixed rate mortgage.
And a credit qualifying streamline, it has all the same features of the streamline without an appraisal. Verification of income, we're looking for the source, not VOEs per se. A credit report is required. Ratios are calculated and considered. You must credit qualify if any of the following things take place, such as removing a borrower from the transaction or following an assumption that was less than 6 months ago. That would trigger a credit qualifying streamline. With the credit qualifying streamline, let me just clarify, we would want to verify the source of income because now the remaining borrowers must be able to handle the mortgage payment. If the borrowers are not required to provide cash to close necessarily, but we're looking more at ratios and credit. If the subject property is a condominium that has had the approval withdrawn, you can only do a streamline refinance without an appraisal. Once again, all streamlines, no appraisals are allowed, and that is a recent change. Now, the following apply to all streamlines. It must once again involve no cash back to the borrower except maximum $500. 501, it becomes something else, so it's capped at 500. You do not need to run a CAVERS or a credit alert number on a streamline. The LDP and GSA is still required for all borrowers. LDP is a limited denial of participation list, and the GSA is another exclusionary list that have to be checked to make sure our parties to the transaction are not on the bad people list with the federal government. Now, HUD, once again, doesn't require a credit report, but MWF does, and we want to see 0 30-day lates within the last 12 months.
Now, with that, we don't necessarily ignore all the rest of the credit, but basically HUD's guidelines say that as long as the borrower doesn't show a total disregard for credit, we're to focus on the mortgage payment itself, and that's what we do.
Yes, and if there are minor collections and credit dings, those, we would not be requiring those to be paid off at all with a streamlined refinance. Now, loan amounts may never exceed the statutory limit for the specific county that the property is, except by the amount of the upfront mortgage insurance premium. Now, seasoning of a refinance mortgage, on the date of the FHA case number assignment, this is extremely important for a streamline. The mortgagor, the borrower, must have made at least 6 payments on the FHA loan that's being refinanced, and these ands are really important. At least 6 full months must have passed since the first payment due date of the refinance mortgage took place, and at least 210 days have passed from the closing date of the mortgage being refinanced. If all 3 of these things have not taken place, you will not be able to pull an FHA case number assignment. If you are trying to move the transaction along faster and then pull the case number assignment as a rate and term refinance to think that after a few more days you can flip it to a streamline, it will really result in a loan that HUD will not insure. So all 3 of these bullets must take place in order to have a proper case number assignment with HUD.
And actually, that's not such a bad idea, since, again, from an industry standpoint, we do not want to be turning over these loans any faster than they need to be. So let's talk about some other type of refinancing. The streamline is about as easy as it gets, and as you can see, both Carla and I are very passionate about this program. FHA has really done a great job stepping up when the industry was having challenges in 2006 and 2007. FHA stood up and fulfilled their mission, which is to be anti-cyclical in the economics of our normal economy and provide financing even when a lot of the large investors and mortgage insurance companies and whatnot didn't. So some of the neat programs that have still remained out there, they will still do or still insure FHA cash out refinance to a maximum of 85% LTV CLTV of the appraised value, effective for case numbers that were drawn after April 1, 2009, and obviously we're much further than that. Mortgage letter 2009-8, and if the home was owned for 12 months or more. So it's important that you're going to use the appraised value or purchase price until it's been 12 months, and then you would just use the appraised value. It's limited to a LTV and CLTV of 85% of the appraised value, obviously if it's past the 12 months, and you cannot on a cash-out refinance have any lates within the last 12 months. Refinancing a no cash-out, which is we call a rate and term for most cases. Again, back to the book page and verse of the 4155, any refinance with an appraisal is going to be 30 years, pay off multiple mortgages and liens, and the loan-to-value can be as high as 97.75%. Seasoning may be required on mortgages to be paid off, and it depends on, again, how long that mortgage has been out there. You need to make sure you get a refinance authorization required on all FHA to FHA refinances, regardless if it's cash out or not, and again, that's because there's an MIP calculation in many cases. And skip payments are not acceptable. So again, as we're doing a no cash out rate and term, you're not allowed to add excess interest in there as far as part of the payoff. A borrower's mortgage payment is due June and expects to close a refinance before the end of June is not permitted to roll in June's mortgage payments into the new FHA loan. So no cash out refinance, or what we call a rate and term, and again, the mortgage calculation is the loan-to-value ratio is applied to the appraised value, and the payoff of the existing first mortgage, purchase money seconds, junior liens over 12 months old, and again, if it's an equity line, the draw, anything in more than $1,000 in the past 12 months creates a cash out and drops your loan-to-value down to 85%. The subordinate financing, if cash out is maximum of 85, again, the mortgagee letter 2010-36, all other transactions are the sum of the liens that cannot exceed 100% of the cost to acquire the property. The cost to acquire is the sales price plus allowable borrower paid non-recurring closing costs, discount points, repairs, expenses, and prepaids. So we have a little bit of a chart here. It gives you an idea of the LTV and CLTV for borrowers that have a no cash out refinance, if they're in a negative equity position, the FHA streamline with or without appraisals, and like Carla said, you can't do them with an appraisal anymore. And again, the cash out refinances. So again, a little helpful chart. Just remember, you cannot do streamlines with appraisals.
The citizenship and immigration status. Can you imagine that citizenship of the United States is not required to get an FHA loan? What a wonderful country this is, you know. You can do an FHA loan for a permanent resident alien or a non-permanent resident alien. For a permanent resident alien, you have to document permanent residency by getting front and back of the resident alien card and a copy of the Social Security card. The borrowers have to have a valid Social Security number in order to obtain an FHA loan. For a non-permanent resident alien, its subject must be a principal residence, the home that they're buying. They have to have a valid Social Security card and evidence that the borrower is eligible to work in the United States. And we refer you to 4155 for more details on that. With respect to credit, we have cited here the community property states. California, of course, is one of the few community property states. In those states, you must take into consideration the credit of non-purchasing spouses in the ratios. So you're going to need to pull credit on the non-purchasing spouse and consider any debts of that non-purchasing spouse in your DTI ratio. A letter of explanation is required for major derogatory credit and inquiries. Don't make the underwriters guess as to what transpired on with the borrowers and their particular circumstances. Have that explained and part of your credit file when it comes into underwriting.
You know, I think some things people don't realize is just because you get an FHA scorecard approval doesn't always mean the loan's going to be approved, because sometimes, remember, scorecard doesn't see everything. So there may be, between a combination of the assets, the bank statements, deductions on pay stubs, tax returns, lack of income, declining income, a whole bunch of things, and then you have a credit profile that's not perfect. You know, to put that extra letter in there sometimes makes all the difference in the world. Again, it's better to strengthen up your loan than it is to have it go in and have an underwriter have to make judgment calls based off of lack of information.
That's true, Gary. You want to help develop credit if there are less than 3 trade lines reviewed over the most recent 12-month period. And you're going to help them shore that up with utility statements, rental payment statements, auto insurance, etc. We cite the mortgagee letter for that. You want to obtain this alternative credit to shore up a thin credit report profile. So a borrower with no credit is not something that we would consider at this time, but a thin credit report can certainly be supplemented with other non-traditional trade lines. You want to verify the rent or mortgage payment history for the last 12 months. This is specific to a manually underwritten transaction or refer. If the loan goes through DU or LP, an automated underwriting engine, this particular requirement is not called for.
Could it also be used to shore up that thin credit report?
It most certainly could, Gary. That's excellent that you brought that up. And now we want to address collections and court-ordered judgments. Those must be paid off unless the creditor and the borrower have made some type of repayment arrangement in writing. You would want to submit a copy of that agreement and evidence that the payments have been made as agreed. This is typically not something that they went out and shook hands on yesterday, but this agreement has already been in effect, and anywhere from 6 to 12 months worth of payments have been made.
Yep, usually we're not going to allow that payment history as part of it, not to be included in a payoff unless we see at least 6 payments. And like Carla said, sometimes we'll ask for 12, depending on what the rest of that financial picture looks like.
Correct. Now, foreclosures and deed in lieu of, that's a big ticket item right now. None in the last 3 years. Foreclosures, deed in lieu of, short sales, short payoffs, those are all pretty much looked at in the same light. but some short pays, the HUD will allow if there have been no lates in the last 12 months.
Man, that's a lot better than conventional financing.
This is a wonderful loan. And then every now and then you'll have a borrower that has had a bankruptcy. When it comes to a Chapter 12, 2 years needs to have elapsed from the time of the discharge date, and we want to see that the borrowers have reestablished credit. With a Chapter 13, they can still be in a Chapter 13 as long as 1 year of the payout has taken place, and the borrowers have been making timely payments over the past 12 months as documented via a letter from a VK judge or administrator stating that it's okay for the borrowers now to enter into another mortgage transaction. Consumer credit counseling is really comparable or looked at similar to a Chapter 13 bankruptcy. We're needing 1 year of the payout to have taken place, and the Consumer Credit Counseling Agency stating that it is also okay for the borrowers to enter into a mortgage transaction. We're looking for credit reports to be 3-file merge, and non-traditional credit references cannot just offset derogatory credit. So some people may say, well, they have all this credit, I'm going to try to offset it. You know, bad credit is bad credit. We are looking for other strong elements of the file to add compensating factors, which we'll talk about to the loan. We mentioned before LDP and GSA, the exclusionary list have to be checked for these parties here. We have a list that is posted on our website that will itemize that a little bit more. On your regular purchase and rate and term refinances, the CAVRs must be checked on all borrowers. That is done via the FHA connection, and for wholesale brokers, we will do that for you here at Mountain West Financial. You would go through our website. Our retail branches have access to the FHA connection. Regarding income.
Well, on the income, what we need to do is verify a full 2 years of employment per the 4155, and again, section and verse. School and or military experience can fulfill this requirement. A couple things. We're not going to touch bases on all the income types because that would be impossible. You know, I've been at this for almost 30 years, and I still run into things that I've never heard or seen of before. But we're going to give you kind of the idea how we look at a lot of these different types of income to help you formulate how the underwriters view and how the processors and or originators should be viewing how the income of whether it has a stable history and it has a fairly good chance of continuing for at least 3 years. So two things we typically look at: do we have a full 2-year history? Do we have a 3-year potential of moving forward? So again, you can use school and military to fill up some of that requirement. Again, it has to make sense how that fits into their current employment experience. Borrowers who just return to work force is sometimes okay. You want to check the 4155, but usually what we're looking for is somebody that was off for longer than, for an extended period, and has been back on their current job for about 6 months, and that we can document a 2-year history between the 6 months that they've been on there and their previous work history. So a lot of times somebody could have been on a job for 3, 4, 5, 7 years, taken a year and a half off, back on the job now for at least 6 months. We'll consider that. Again, we have to look at the entire loan picture. You also want to make sure that if you're averaging any type of normal type of income, bonuses, overtime, you want to look at that 2-year average and evidence or something to show that the continuance is very likely. Same thing with part-time. You know, a lot of times people will blend. I have a full-time and a part-time job. Do we have that 2 years of history of being able to work that part-time job and or mixed in with my full-time? Now, also, their seasonal jobs are considered interrupted. So that means if somebody has worked and they work every year, and typically, again, we're going to go back, and seasonal, we might even look back 3 or 4 years to show that they've done that every year, and then we're going to make the leap in most cases with a letter from their employer that says, I will hire them on next year. And we see a lot of seasonal work. Some work during the winter, some only work during summer, some only work during fall, and there's a lot of different pieces of employment that fit in there. Commissions are also averaged over a 2-year period. And again, we want to, the likelihood of it continuing has to be there, but you want to also provide a 2-year 1040s and most current pay stubs. Actually, in all cases on an FHA loan, we're going to ask for the last 2 years' tax returns, and we're going to look at the different incomes in there. Many times somebody will have an income stream that has either just started, has only been out there 6, 12 months. Many times if it's new, we can't include that. It could be a compensating factor, and we'll go through that in a little bit. But you want to make sure that you have income that is on your tax return 2 years, and then pay attention to those returns for other things that show up, like unreimbursed business expenses that we're going to have to subtract from your borrower's earnings, and a lot of times we would just refer to that as a 2106 expense. There's other income out there like alimony and child support. Again, we're looking for documentation, usually a court order, that that's going to continue for 3 more years, and obviously it's had a history. And we're going to provide final court-ratified divorce decree to show income, evidence of the receipt of last 12 months. Sometimes if you're getting a DU approval or a scorecard, it'll ask for as little as 3 months for receipt of the child support. And again, it can be grossed up per Mortgagee Letter 2005-16.
With regards to MCCs, those are mortgage credit certificates, we have here that it can be added to the income or directly offset the mortgage payment. I highly recommend that you use it to directly offset the mortgage payment. So you have your principal, interest, taxes, and insurance, and monthly MI, and then you subtract the MCC credit, which is, it ranges from either 15 or 20% depending on the program off that housing payment, and it will help your borrower qualify.
Great.
Government assistance programs, they are acceptable subject to the following: documentation from the paying agency that the income will continue for 3 more years. And if a borrower is receiving periodic unemployment, you need to document a 2-year receipt of that. However, to roll that in and use it as income, we're looking for a borrower who is in a trade or profession that typically has periods of unemployment throughout the year, such as a laborer or a tradesman or someone in the construction field. Auto allowances, you can only use the amount which exceeds the borrower's auto allowance or expense as documented by tax returns. You need verification from the employer that the income will continue, and the auto payment still needs to be included in the ratios in its entirety. So some people try to net that out, the payment versus the auto allowance. You need to put the payment and liabilities in its entirety. Assets, we're talking checking and savings, and we like to refer to and look for liquid assets, monies that the borrower can readily get to know that they have enough to close the particular transaction. So we're looking for VOD, verification of deposit, and 1 current bank statement, or document that with 2 months consecutive bank statements as long as they show starting and ending balances. Now we have a lot of transactions in which the borrowers are getting gift funds to close. First of all, the amount of gift funds that the borrower is receiving need to match perfectly, exactly to the gift letter. The donor may not be a person or entity with an interest in the sale of the subject property. It can be no payment of the gift funds, no payment expected or implied. That's what gift really means. Only family members can gift equity. That is allowed. So you have to document the gift with a gift letter, which will reflect the donor's name, address, and telephone number, the exact gift amount. They can't say they're going to give $5,000 and then the borrower only receives $4,500. Then the underwriter would have to reconsider the loan and make sure everything still qualifies at a different gift amount. No payment can be expected or implied. It must state that the funds didn't come from the seller, builder, or any interested party. We want to have documented in the file the donor's ability to gift the funds. So you're looking to obtain a copy of the donor's bank statement showing that they had the funds available, significant funds, at least to cover the gift available. You want to obtain a cancel check or withdrawal slip showing the money coming from the donor's account to the borrower, either in the form of a deposit directly into the borrower's account or going straight to the closing agent with a receipt from the agent. And please note that cash on hand is not an acceptable source of funds. And nonprofit donors are allowed. Funds cannot pay off debts or derogatory credit if they are coming from an acceptable nonprofit program.
So let's talk about loans. Can people borrow money for the down payment on their home? Well, in fact, they can in some cases. What they can borrow money on is something that's a collateralized loan. If they have an asset that they can put a loan against it, what we really see a lot of times is a 401k, and they do not require consideration for repayment for qualifying purposes. All other loans must be the payment taken in consideration. So it must be an independent third party, unacceptable borrowed funds or signature loans, cash advances. Again, there's no collateral on that. Borrowing against household goods or furniture. So you can't create a collateral loan against, something like a couch or so on and so forth. You could do a car, but not a couch or similar unsecured financing. So you can also have the sale of personal property. And we've seen this through the years. We've loaned in almost most of the Midwest states, and we've seen everything from coin collections to
baseball card collections. I've had people sell birds, macaw birds, and for collateral and give pictures that they own the birds and the birds being on their shoulders. Anything that you can put an estimated value or worth on that can be documented could be considered.
Right. So some key components to that is you have to absolutely be able to provide the proof that you owned it, proof what it's worth, and proof that somebody purchased it from you, or from your borrower, I should say. So there's a lot of other things out there. Again, this is not an all-in. These are the only ways that funds can show up for down payment, because there's a lot of other things. Borrowers may have a huge deposit they put on their existing rental that they'll get back at, before moving in or whatnot. There's a lot of places money can come from, but remember, it just can't appear. And if you're doing, some of even employers, like an employee assistance plan, can be out there, and that can be used without affecting loan amount. A salary advance, though, again, because that's an unsecured loan, cannot be considered as assets to close. You also have an IRA, thrift plan, 401k, KEO. Now that can be included in analysis of not necessarily cash to close unless you're going to turn it in, but you can also use that as part of your reserves when you're calculating assets.
60% of those accounts.
Right. So stocks and bonds is pretty straightforward. You have to verify what the account is, what the value is, those stocks, and a lot of times you can print that out of the Sunday newspaper or online. And then, or if you have a statement that you receive monthly that shows that. And if you're cashing it in, you're going to have to show proof that you've actually received the funds and by verifying and documenting it.
Now, cash saved at home. Now, you have a lot of people, they say, we just saved this money at home in the cookie jar or master's money, whatever they want to call it.
I have $42 at home.
Wow. I think we'd want a little bit more of money from home in order to close your transaction, Gary. But the money must be verified. It needs to be deposited into a financial institution held by a title or escrow company. And the borrower needs to provide evidence of their ability to accumulate such cash savings at home. They want to explain to us how these funds were accumulated and over what period of time, how long it took them to do it. So typically we're looking for a budget letter. This is my gross net income per month after I paid my housing and bills. This is what I had left, and I've saved this over the past 12 months, etc. Borrowers should meet the profile of a client that does not typically use financial institutions for savings or checking accounts or credit. Now, MWF will consider up to $3,000 of cash on hand under these particular circumstances.
No, we must be clear. HUD actually does not have a maximum amount, but you will find with working with Mountain West that we will cap that off at $3,000 cash on hand. And again, you have to be able to document how the borrower was able to to not only save that, but the fact that they don't use normal checking, savings, and credit cards as a means of how they handle their finances.
As far as using commissions from the sale, that is also allowed only if the borrower is a licensed real estate agent or a family member entitled to the commissions may provide gift funds, gifting the commissions toward the close of the transaction.
So they can get commissions and use it as part of their down payment?
Absolutely.
Wow, this is another thing that FHA allows that you can't do on conventional financing.
What a wonderful program.
I like it.
Acceptable ratios. Now, for a standard FHA transaction, a manually underwritten transaction or refer, FHA has benchmarks of 31/43, 31% housing ratio, and the total debt ratio is 43%.
So as long as I meet that, do I qualify?
Well, we're going to look at other things, but if it goes through DU or FHA's total scorecard, we will take the ratios as high as the scorecard will accept them, provided all of the information has been validated. Now, there, on a case-by-case basis, we will allow ratios to be exceeded, and we'll talk shortly about compensating factors. Now, with respect to projected obligations, any student loans, and student loans is one of those obligations that is projected to start in the future, and sometimes you'll say, well, I don't want to hit the borrower with that particular payment. If the student loan is scheduled to begin within 12 months of the anticipated closing date of your loan, you have to include the student loan in the ratios. So if the credit report simply says deferred next to that student loan, you'll have to obtain information from the student loan agency or that particular source as to what that payment will be.
So the obligations that are not considered debt, and there's probably some others out there, but again, these are ones that are listed that we're fairly confident and aware of, which is your federal, state, and local taxes. Usually you're going to find that on either your tax returns or a pay stub. FICA and other retirement contributions, including repayment of debt secured by these funds. Remember, you can borrow from a 401k plan, so even debt repaying that is not included in obligations. Commuting costs, union dues, open accounts with zero balance, auto deductions to savings accounts or Christmas accounts, those type of things, child care, voluntary deductions that are not court ordered. Now I want to stop there for 1 second because, again, when you're putting together a loan file, remember that still prudent loan packaging and underwriting, you need to take some of this into consideration. Absolutely right, we don't hit somebody with commuting costs. But if somebody's making $14 an hour and they're commuting 2.5 hours back and forth to work, we want to make sure we don't put a borrower in a position where they can't afford their house payment. So if their ratios are high, remember Carla was talking about the 31/43, or the scorecard ratio, and yet we have this really huge commuting expense, we might not consider it in there, but sure, if it's a borderline case, that would probably tip the scales in the wrong direction. So do keep some of these things in mind, but know that they're not included in your normal debt-to-income ratio.
And what we also have listed here are compensating factors. These are the standard ones that are listed in the 4155. So if the borrower's ratios on a manually underwritten transaction were exceeded, either one or both, the housing or the debt-to-income ratio, we would like to see that there are compensating factors with the file. Typically here at Mountain West, we want our underwriters to be able to cite at least 3 compensating factors as to why they are exceeding the ratio guideline as outlined by HUD. So not to go into all of them in detail, but you will see some of them. You have a borrower who has successfully demonstrated an ability to pay a housing expense equal to or greater than the proposed monthly housing. Borrowers who are making a large down payment, 10% or more is the definition of that toward the purchase of the property. Certainly those are comp factors.
So now what's the maximum amount that we will do on a traditional or manual underwrite with a back-end ratio?
Well, we here at Mountain West will go as high as 47% on the DTI with compensating factors such as the ones that are listed in our webinar here.
Now, and that's without a scorecard approval, and again, some other factors that make that file approvable by our underwriters. But if you put it through the FHA scorecard, through DU or LP, and it has a back-end ratio that exceeds that, as long as the rest of the file supports it, we'll do that loan as well.
Now, there are a lot of institutions out there that currently will not consider a manual underwrite. They've gone totally to an automated system. But we here at Mountain West Financial still want to put a human touch behind the borrowers who are seeking home ownership here. That is very much in line with our mission statement of making home ownership a reality. So sometimes every transaction will not fit perfectly into the box, but we have underwriters on staff that will look at the strengths of the file and assess that this is an acceptable credit risk in order for us to assist those borrowers to become happy homeowners.
You know, and this is where a seasoned loan officer and or processor that really do their job weigh in, because you could take a file that is just on the verge, and like I said before, sometimes there'll be negative factors, but also the compensating factors. Just because you reach the ratio, sometimes it's well worth your while to put in those additional factors, because it may offset something else that either you overlooked in a file, or it may stop an underwriter from conditioning additional things that they might not need if they see some other strengths of the file that help them with their decision. So there's some other special underwriting instructions. Again, we're not covering everything, because that 4155, Carl and I could be here for days.
Forever.
But we're going to cover a few other things that we see quite often. Temporary interest rate buy-downs. Now, they're permitted only on purchase transactions. So remember, you can't do that on a refinance transaction. It can only be used on fixed-rate loan mortgages. The 2% is the most reduction, and you're going to qualify at the note rate per mortgagee letter 2004-28. Adjustable rate mortgages, FHA looks at them a little different. You're going to qualify at 1% over the note rate. 1% over the note rate, unless the loan to value is less than 95%, then you can qualify at the note rate.
Now, we here at Mountain West Financial, we do energy efficient mortgages. Yes, indeed. We want to help the borrowers get into a home that's going to save them financially because of the energy improvements. So with that type of loan, which is part of a standard FHA loan with that feature, the qualifying ratios can be exceeded by up to 2% top and bottom, which would take it to 33.45, and that's still without compensating factors. Now, this is only for existing 1- and 2-unit properties. The maximum amount for the portion of the EEM for energy improvements is the lesser of the actual cost of the improvements, or 5% of the value of the property. The FHA appraised value appraiser will indicate what the value is, and the DE underwriter will back that up on a statement of value, or 115% of the median area price for single-family dwellings, or 150% of the conforming Freddie Mac limits. But the point is, we want to do those loans here. Now, FHA's maximum loan limit for a particular area may be exceeded by the cost of the EEM improvements. Before, we also indicated that you can exceed a loan limit area by the amount of the upfront mortgage insurance premium. You can also exceed it by the cost of the EEM improvements. Those are the two exceptions to the rule there. You have to have a physical inspection of the home by a home energy rating system person or representative called a HERS representative.
Instead of a HIS?
Instead of a HIS, it's a HERS, female power again, to determine the energy improvement items, including the maintenance costs and the estimate energy savings. And we have hosted on our website some HERS representatives that cover all areas of the state to assist your borrower with that transaction.
So we're going to take a couple minutes now and go through some basic documentation that's required. And this is not only for FHA loans, but for most loans. But I'm going to go through this relatively quickly because, again, you have these to refer back to, and in most cases, we also have some very good lengthy processing, very in-depth processing courses that are out there if you're looking how to properly package a loan. So first of all, you need an application package. All documents may be no less than 120 days old at the time, or no more than 120 days old at the time of loan closing, 180 for new construction, although we are going to want updated pay stubs at closing. You have to have an URLA, Uniform Residential Loan Application, or we call it a 1003, and the addendum of the HUD 92900A, of course that's a 4155 again. Social Security number and evidence is required on all purchase and refinance transactions for our borrowers, including a streamline. And the Social Security number's evidence is required on all purchase and streamline refinance. Income, a written VOE and or current pay stub, or alternative documentation is also allowable. Usually if we're doing alt doc, you're going to have W-2s for 2 years and pay stubs that cover an entire 30-day period. Now the reason why that's a 30-day period is we want to see during that length of the month, first of all, if there's any bonuses or deductions or something that could be a one-time month, and or we want to see how regularly that person's paid. So again, it depends on when they're paid, but if it's weekly, you're probably going to need 5 stubs. If it's twice a month, 2. If it's every 2 weeks, 3. You also can do a verbal VOE for all current employers is required as part of our verification process.
You want to obtain a 4506T also on all of your transactions. And with respect to assets, once again, that VOD and most recent statement or the alt doc, 2 months recent concurrent bank statements. Be sure you get all pages of those statements. So even if you have a 6-page statement and the last statement is just used for the borrower to reconcile, you want to have all pages of the statement. You don't want to have 5 out of 6. VODs and VOEs can be fax documents provided that they clearly identify the source that they came from in the header or some type of fax cover letter. Be sure that these documents are not being handled by loan officers or agents with an interest in the transaction that will be receiving commissions, etc. They need to be coming directly from the verifying sources.
To the processor. So let's talk about a couple miscellaneous things. Anti-flipping rules, MWF, will allow the 90-day waiver in compliance with HUD guidelines. The transaction is reviewed for rapid appreciation and analyzed for the increase in value. Proof of property improvements must be included in the file and noted in the appraisal. And again, this is our internal bulletin 11W-25. 91 to 180 days, we'll need a second FHA appraisal, and 6 months to 1 year, we'll need a second FHA appraisal in some cases. And again, that's a call for by the underwriter depending on the amount of value increase that's happened. If the seller is a bona fide lender or GSE who looks back, who took back the property, then the rule may be waived. Otherwise, it's applied to all.
Non-occupying co-borrowers. The maximum mortgage may be limited to 75% LTV. Now, you can exceed that if the non-occupying co-borrower is a blood relative related to the borrower, not one that they've just met, but there truly is some type of relationship here. If that's the case, you can exceed that 75% LTV, but the property has to be a 1-unit property. It cannot be 2 or more units, which could be perceived as your non-occupying co-borrower trying to gain investment property.
So case numbers, you must have an originating lender company as the sponsored originator and Mount West Financial as the sponsor on a wholesale loan transaction. On a retail transaction, MWF must reflect as the lender. If a case is ordered with another sponsor or lender, then we will need 2 things. We'll need an electronic case transfer. Well, actually 3 things. We're going to need an electronic case transfer and a DE handwritten letter stating the loan, what's happened at the other lender, and 3, we're going to need a copy of the appraisal. We must have the case number in our name prior to drawing documents.
Now, beginning this past, April of 2011, the FHA Connection will now automatically cancel any uninsured case numbers where there has been no activity for 6 months. Prior to that, case numbers never expired as long as the transaction had not closed. So please know if you have a case number, you're getting it transferred from one lender to the next, and it's been out there a while, HUD may have automatically canceled it, so do a case query to make sure that case number is still valid. FHA no longer requires repairs, termite reports, or well and septic inspections unless there are health and safety issues or the appraiser calls for the repairs or inspections. HUD really focuses on the 3 S's now: safety, security, sanitation. If any of those things are present, then inspections may be required.
What about sanity?
Sanity? Well, that would be the 4th S.
Okay, FHA Jumbo, or we call them high balance. You must have a DU or FHA scorecard approval, which means that we would not be underwriting those without them. And in some cases, your ratios will be limited to 31-43. But with that scorecard approval, and we will go up to 50% with a FICO score of 640, and we'll go up to 55% with a 720 FICO score. You must have FICO scores for 640 for purchase rate and term and 640 for cash out or units as well. Maximum ratio is 31-43 for units, and there's no exceptions to that. And the pricing and guideline changes at 417. So you want to be careful if you're looking at pricing these loans and you're going through our price query, then it will automatically hit adjustments on there once you exceed the 417 in those counties that allow for the higher loan balances.
Now, here is a screenshot of our web page entering as a business partner. So you want to click on Business Partners, and then it will take you to our wonderful website, and you will have to put in the user ID and password.
MWF, Mount West Financial. And actually, I should change that password to 22 years since we just went through our 22nd year anniversary.
Absolutely. Wow. Happy anniversary.
Oh, thanks.
And then we have different features you can click on. If you'll notice to the right, FHA case numbers, you can order your case number here online. So you click on that. It would take you to the FHA case number screen, and you would fill out the form for a case number to be assigned to you. And this goes through our appraisal department. They can pull queries for you, CAVERS authorizations, etc. So we need a case number for all FHA loan transactions. Here's a close-up screenshot of an actual case number assignment that on a retail transaction the branches will pull, and for wholesale our appraisal department will order for you. You want at the very top left-hand corner it to say that the case number has been successfully assigned, and if there are any warnings, please take note of those. This is a warning here. Pending borrower validation. It's in holds tracking, and you have to check the next business day. Our appraisal department will do that for you. On a retail level, you need to also do that. There are other various warnings. There are some areas in which, such as Wrightwood, California, that have to have special handling due to the soil conditions there, etc. So please do not ignore the warning. Then you will have your case number. You'll have the 3-digit prefix followed by 7 digits, and then you will have to assign the last 3, which is going to be what they call the ADP code. If this is a sponsored originating case, yes or no. So for retail transactions, there will be, the broker will be as the sponsored originator with Mountain West as the sponsor to the right. Other than that, on the retail transactions, MWF is the lender. You'll note that this is a fixed rate transaction. If it were armed, then you would want that indicated, etc. But this is all based on the information that you provide to Mountain West on a broker transaction or retail, what you put into the FHA connection. This particular loan is a standard FHA 203B, think B for basic loans. As you continue on with the form, there's other information such as the year the property was completed. You want to have, you may not have to put the month in there, but certainly you want to have the correct year completed. You want to verify that the property address is accurate. if it should be street versus road, etc., you would want to have that corrected. The property address, as indicated on the FHA case number assignment, is how it will print out on the mortgage insurance certificate from HUD backing this loan. And then the CAVERS number, or the CAVERS authorization. CAVERS standing for Credit Alert Interactive Voice Response System. You want this number to start with an A. It will give you a case number when you put the borrower's name in. It's going to be last name, comma, first, middle, and a social. Of course, we've eliminated the social security numbers just for security sake. But you want that CAVERS to start with an A for acceptable. If it starts with a C or a D, there's a claim against the borrower that you need to have resolved before you can proceed on with the transaction.
Well, now that we have a loan application, now that we have a case assignment, I'm going to go through a little bit of a loan application. I know that all of you have been involved in lending, so we're not going to bore you with every single detail, but there's some things out here that you absolutely need to make sure. You know, I personally, if I were doing an application every field that I don't put something in, I would typically put an X or a 0 or something so that people know that I answered those questions. But so a few things, make sure your address is correct, right? I mean, it's got to be the exact same as the case assignment that Carla was just going through. You also want to make sure that you click whether it's a primary residence. We're doing FHA loans. Almost always you're going to do a primary residence unless you're doing a HUD REO or soon to be a 203K or 203K streamline. Some of the other things that are out there that you want to where's the source of funds? Lead that underwriter to where they should be looking for it. If it's 401K or savings or gift or money saved at home, then obviously they know then what documentation to start looking for. Make sure that you've covered where your borrower is living and how long should they have lived at the place, Carla?
Well, we need a 2-year residency documented here. So if they've lived there less than 2 years, we want to know everywhere they've lived for the past 24 months.
Look at the documentation in your file that you've obtained from the borrower, their tax returns, their bank statements, their driver's license, anything else that you've got an address on. And if the address doesn't all say Nightmare Road because they've been there 8 years, you need a letter of explanation. Remember, as we chatted before, you know, you need to explain the stuff that shows up, because if I've lived at the same place 8 years, all of my documentation should show that. And if 3 or 4 other addresses show up, that's going to be a stop once the loan gets into underwriting.
And I can't understand why anyone would not want to live in freaking California.
I think I lived there when I was younger, actually. Okay, so one of the other things is I can't understand why somebody wouldn't want to work at Fat Daddy's. Make sure that if the borrower is self-employed, because this is one of the ongoing things, even if it's not their main employment, if there's a self-employment piece to this, it needs to be run through the FHA scorecard that way. So even though they've worked at their job 2 years or they've worked at the same company, if they are self-employed, and how much of a company do they need to own to be considered self-employed?
25% or more.
So if they own that 26%, they are considered self-employed, even though they don't own the rest of it. And again, all you want to make sure is that everything's filled out. One of the things that we do see quite often is somebody will put in other in this other employment, and they won't say what it actually is. And by doing that, first of all of you have a drop-down list in your origination system. So you want to make sure you use that, so then either whether you're going through scorecard or DU or LP or whatnot, it knows what documentation to request. If you just put other in there, then you have to go back to the 4155 and document other income with a 2-year history and a 3-year continuance. Some other things you just want to be cognizant of as you look through this is make sure that you put in accounts, you make sure the documentation you put in for assets is pretty much what you have at the end. If there's any significant changes from the initial to the final, you want to make sure that there's a letter that says something, because if I put $1,000 in here now and at closing all of a sudden I have $15,000, well, where did the rest of the money come from my original assets? Same with liabilities. If you have liabilities listed on here and all of a sudden a credit report and there's 8 more liabilities, why did the originator not fill out the application properly to begin with? Do you know the reason, Carla?
I don't know, but we have webinars that will cover that.
We do. So this is the bottom part of page 3, and again, it shows other areas. One other thing to take into consideration, you see these little spots down here, alimony, child support, settlement maintenance, job-related expenses. Don't hesitate filling those in there, especially if you're on a processing system, because it will automatically add that up and include it in your figures so that at the end of the day, your ratios come out the way they're supposed to. Remember, there's a lot of important information down here, and you're signing it as well as the borrower, talking about acknowledging an agreement. But more important than that, you want to make sure that your figures add up. This should give you an idea of what the cash to close from your borrower is going to be, and that includes the sales price minus concessions plus closing costs minus any other subordinate financing or credits, your MIP, your total loan amount. Don't forget to ask the borrowers questions and make sure these are filled out correctly, because if you've asked them, have you declared bankruptcy in the last 7 years, and they say no, and one shows up on scorecard, then it's going to ask you, it's going to red flag and say that this does not line up with what the application says. Make sure at the end of the day, you cannot take a loan application that does not have your signature on it and your borrower's signature, and they must be dated. And it also needs to say, did you do the loan face-to-face, by telephone, or application was submitted by mail or fax. And always remember to put in this information here, or I do not wish to furnish it, because all lenders are required, and all brokers, all loan officers are required to complete their HMDA stuff. And now we want to make sure, because we're all licensed originators, that both the identifier for the originator and the company are properly filled in on all loans. That's a biggie.
Now, when they're taking the initial application, some people call it the handwritten. It doesn't necessarily have to be handwritten with the loan origination systems that are out there, but the initial one, you're going to have an initial URLA, or Uniform Residential Loan Application, and you're going to have an initial addendum to the application, which is HUD Form 92900A. You'll notice that form number in the bottom right-hand corner. With the 92900A, the initial one, you need to submit pages 1 and 2. So this is really preliminary information, and then after you have validated the information that the borrower gave you up front, then that's when you are going to put together the final 1003 and the final addendum to the transaction. So this is a part of the initial one, and it's perfectly fine for your loan officer to execute this up front, and you'll have page 2 with any preliminary information signed and dated by the borrower. This is a close-up of that. And you want to check the appropriate boxes. You'll notice that this is a dual form. It's used for both VA and FHA. So you only want to consider the questions that apply to FHA. Now this is just an FYI on additional disclosures, which here at Mountain West Financial, these disclosures are going out with your disclosure package from our disclosure department. But just so that you know that FHA calls for these items. An EEM disclosure or fact sheet telling the borrowers that that particular feature is available to them. The Informed Consumer Choice Disclosure Notice, which gives a comparison of a conventional loan to an FHA loan. The HUD Appraised Value Disclosure, which tells them that this is what their value is. However, the DE underwriter has the final authority on what value is going to be. For your protection, get a home inspection. We certainly want all of them to know that they have a right to get a home inspection prior to the close of the transaction. And the important notice to home buyers, which is HUD Form 92900B, which basically tells them that everything's negotiable, you know, when it comes to the rate and points that they pay on the transaction.
So now we did our initial 1003 or URLA. We had our initial addendum to the application, and as Carla pointed out, we have additional disclosures. Now, we have all the rest of the normal disclosures go with this, but this is just specific to the FHA loan. So now afterwards, we've completed everything. We've typed up our final application, because also the application goes into HUD for insuring or endorsement when this is all done, and this is the loan application that they look at, and it's got an addendum attached to it also. But just a couple things. Now you're going to have your agency case number, and like Carla said, you're going to have a prefix and a suffix. You're also going to have on there your year built, and that's really important as you're doing like refinances, and also for lead-based paint and some other things that are required based off of how old the property is.
And you're going to pick that up from your appraisal.
You have your 2 years that your borrower has, where their dwelling has been, whether they've rented or owned. And again, we're looking at the borrower's Social Security number, make sure that that's been verified and run through the CAVR system. We want to make sure that they have their income. Again, we're looking for a 2-year history. And we're looking to make sure that these are not P.O. boxes. If ever the borrower is taking an application from you and they give you a P.O. box, know that you're going to need a physical address there as well. So the bottom part of the application, again, all we've done is fulfilled it and gotten down to the end where we have a complete application, everything typed out. We'd also mentioned before, make sure that the amount of rent or their current house payment is in there, because as Carla said, that's a compensating factor. If they're paying about the same amount, in this case they're paying slightly more, so it wouldn't be. But many times an underwriter is going to say, well, what are they paying now as we're trying to analyze what's their ability to pay in the future going to be. We've completed the assets and liability part of the application, made all the totals up there, and then on the back, again, the details of transaction, the top left-hand side, purchase price, closing costs, and almost all of this, if you fill out your good faith estimate properly, everything should be populated over here. But just know that when we get down to where it shows cash to close, if this is more than the borrower has in assets, either you've done the calculating wrong or the borrower doesn't qualify for this loan. So just be cognizant of that. All of your questions need to be answered. And are they a citizen? Do you intend to occupy the property? So on and so forth. The acknowledgement and agreement, that's just part. And then we get back after we've signed that and we made sure that our origination numbers are in there. Then we get back to the HUD VA addendum to the application. As Carla said, the 92900A.
And for this one now, with your final typed application, be sure you submit all 4 pages of the 92900A on the final.
So it's just 2 on the...
Just 2 up front, but all 4 pages on the final. Now, it's very important on the final, Mountain West will be the lender because we are going to be the funding institution here. So you want to have Mountain West in box 15. You want to show our lender ID number in box 13. And we will be the authorized signer on at least 2 of these pages here. So on page 1, we will have an authorized individual at Mountain West execute the bottom of page 1 on the final, and also on page 4. Now on page 2, they execute all of that. You're going to go through it. Line item 22A through E applies to FHA only. Box 1 question here on 22F, do you own more than 4 dwellings? You know, those are things that could be red flags. But please note line 23 applies to VA only, so you would leave that blank. So does the bottom when you get to 25. You want to come down to 25, section 3, which talks about what the appraised value of the property is, as determined by the FHA underwriter, HUD FHA, and you will have the appraised value in there. And then you'll come to 25, item 3, and then you have an A or B, if in fact there was a difference between the appraised value and the actual sales price. Because the borrower can indicate that, yes, it's a difference, say it's a $1,000 difference, but they can choose to pay the difference from their own resources. They can say, I wasn't aware of the value when I signed my contract, but I still am electing to go through with this transaction at the original purchase price, and I'm going to pay the difference out of my own pocket. That's certainly acceptable. And for any properties built prior to 1978, the borrowers have to receive information on lead paint poisoning, and that is taken care of with the agents on the transaction. This is page 3 that you will include, and this page should be left for the underwriter to complete the bottom. It's what we call the firm commitment, and once the loan is approved, your underwriter will complete from the section Sponsored Originators on down and have this in the final package. This is page 4. We will send it out with loan documents. Your borrowers need to sign and date about halfway down, and when the forms come back with your loan documents, then an authorized Mountain West officer will execute the bottom portion on behalf of Mountain West, the funding lender.
Well, here's where the fun starts, because now we get to look at and doing some of the math on here. Here's an overall picture of what we call the LT, which is a summary of your application, all of your assets, liabilities, PITI, and information about the borrower and the property. So to take a little bit closer look, what we have on here is on the top section, you'll notice that, again, we have a sales price or appraised value. So it's counting whichever is the highest. And all this information should be populated from your LOS onto, first of all, your 1003, and it's going to pull information from usually your good faith or whatnot. But you have the purchase price or appraised value. Then next thing, we want to make sure that you check all that apply here. This is very important. We see this not filled out as much as it should be.
Because you could have a purchase. It's also an EEM loan. That's also a HUD REO. I mean, so you want to, it could be, if it's a streamline, we want to say that it's without an appraisal, but it could be multiple items that need to be checked here. And just know your starting point is always the lesser of appraised value or sales price in calculating the mortgage that will be financed.
So your mortgage amount is going to be a percentage of that. In most cases, it's going to be your...
You're going to take the lesser of, and our max financing for HUD currently is 96.5%. So in this case, we would take the $165,000 sales price times 96.5, and it will give us our base loan amount of $159,225. So you're always going to have a base loan amount, and then the loan amount when you put the upfront mortgage insurance on, and that will be the gross loan amount or the net loan amount. Let's go back one screen. After we get that base loan amount, you're going to apply the appropriate upfront MIP factor. Currently, it's at 1.75%. So we take, in this example, the base loan of $159,225, and we multiply it by the factor of 1.75%, and that's going to be the upfront mortgage insurance premium. You add that to the base loan, exclude any cents or change, and that will give you your total loan amount. Now, in order to calculate the monthly MIP, also known as the annual mortgage insurance premium, you take your base, time of factor. In this case, the factor is 1.25%. Divide that by 12 to give you your monthly or your annual premium. We're going to go into how to calculate the annual premiums in a few more slides, but please note it's going to be based on your loan to value, the term of the loan, and loan amount.
Some other things to make sure you take in consideration, like Carla had said, you know, this is somewhat of a complicated form, but it does take most of the information aside. But just like you can have several loan purpose codes, also know that if you're getting gifts or you're getting down payment assistance from somebody, that those things are written in there with an identification of who they are. So that's not filled out as much as it should be, and again, that kicks off some other items, not only for our underwriters, but also in the FHA insuring screen when it's all said and done. This is the bottom part of the form, and again, it's taken most of the information and adding it into here, including your MIP, your hazard insurance, your taxes, and that's going to end up giving you a total payment, PITI, which again is part of the calculation of your payment, your PITI divided into by your total income, and those are giving us the ratios we're looking at to underwrite. You notice the CAVers that Carla talked about earlier has been populated here. And usually, if you're putting it in your LOS system, it's put in there as far as LDP, GSA. You can go in the system and check that. This also gives us borrower's funds to close, talks about seller's contribution. So it's pretty much everything on one form. It's a summary, and the underwriter not only uses this to as their worksheet to check off and make sure these numbers are accurate, but at the end of the day, They're either going to sign it with their own personal CHUMS number, or they could use a CHUMS number from scorecard, DU or LP.
You want to leave the underwriting comments blank because the underwriter will utilize that to put in compensating factors and really to justify the loan on behalf of the borrower.
And because our government has added clarity to how the lending system goes, what we want to do is show you the new clear chart for mortgage insurance premium. This is one of a couple charts we'll show you.
And please note that this chart of premiums is in effect as of June 11, 2012.
Boy, this is hot off the press.
Hot off the press. So this is for all FHA traditional purchases, or what they call forward mortgages, and refinance products. It's going to be based on the loan amount, if it's above $625,500 or below. Also, we have to take into consideration the term of the loan and the loan to value. So look at this carefully. Please note that the upfront mortgage insurance premium is 1.75%. That went into effect April the 9th. However, adding the other layer based on loan amount went into effect June 11. So your monthly or annual will change based on the term of the loan and the loan to value and loan amount. We are also showing the charts that were available prior to June 11, 2012 for case numbers that are already out there and assigned for you to have as reference. We're going to hit a couple more highlights on the LT or loan transmittal form. One is the borrower's funds to close. As Gary mentioned before, if your bottom line is they need a certain amount of money and they do not have that, you're going to have to stop and figure out where the additional funds are coming from. So we want to see on here the required assets, what has been verified, break out the closing costs, state where they're coming from, checking, savings, gifts, etc., how many months of reserves, and if the seller is contributing anything to this transaction. Then you have your ratios, the loan to value. In this case, we're looking at 96.5%, but remember, LTVs can be higher if you're doing a rate and term refinance. You may be at a 97.75. And then your housing ratios, along with the credit alert and LVP fields.
You know, and a lot of people don't realize that there's more information to this. There's actually page 2, and it goes through and discusses some of the information that the borrower would want to understand and what we as lenders are required to do, and an explanation as to where some of this goes from the front side. This helps you if you're trying to go back through and populate the front with the correct information.
Now we're wrapping up here. We appreciate your patience, but we just have a few more items that we'd like to bring to your attention. Cover letters. Oh, what a wonderful tool a cover letter can be. You want to use a cover letter to explain any extraordinary situations. If you're missing documentation and you're aware of it and you're going to have it any time now, but you have a severe time constraint, you want to let the underwriter know that up front. Any unusual circumstances, as I mentioned, such as time constraints, definitely utilize a cover letter.
So the documentation expiration, like I mentioned before, the documents can't be over 120 days old. Always when you take an application, get the information that you need from them at the time of application and tell them during the process, I'm going to need updated information for both bank statements and pay stubs. Always give yourself that additional documentation because you never know when you need it. Also, if you're doing Cal FHA loans, they require state pay stubs dated within 60 days of compliance approval. So you're going to need those updated stubs for that program as well. The FHA appraisal is good for 120 days, not 4 months, as some people say. And the FHA case numbers, like we mentioned before, will be automatically canceled in any situation where there's no activity for 6 months.
And repair items, we mentioned before, FHA no longer automatically requires repairs, termite reports, wells, septics, unless there's some type of health or safety issue or the appraiser calls for the inspection. As I usually like to say, if the appraiser sees termites, it must really be bad because the appraiser is an appraiser. However, you know that your buyer and seller can always negotiate these items, and they may be part of your contract. So if you see an underwriter call for it, go back to your purchase contract and see if that was slipped in there, and that's why the condition would be out there.
So other inspections or certifications, appraisals are required except during streamlines. Termites are not required, but they could be, again, based off of either a physical inspection from the appraiser or if it's required inside the contract. Septic, recommended, not required. I personally, through my earlier careers, have replaced some borrowers' septic system. Myself and a real estate agent split it 50-50. I learned long ago I would rather an expert come in and certify that as opposed to me having to come back and pay for it later. Well, water recommended. Again, we want to make sure you have professionals verify that when a consumer gets into the property that it's everything that they'd hoped it would be. Roof is not required. However, if it's a flat roof, it will be. No, we're going to follow, first of all, we're going to follow some common sense requirements. If it's, like I mentioned here, it says per HUD if it's required or not, and also if it's in your contract or a visual inspection from the appraiser.
When it comes to flips again, property flips, 0 to 90 days, we're going to comply with HUD's waiver, but you're looking to obtain 2 FHA appraisals. They need to have the case number, same case number on both appraisals, a home inspection report, cannot be any identity of interest in a property flip transaction. If the flip, or if this has taken place between 91 and 180 days, you have to have 2 FHA appraisals with any value increase over 100%. So if they bought it for $80,000 and it's being flipped for $160,000, you're going to need a second appraisal. Please note that second appraisal cannot be paid for by the borrower.
And just something else, identity of interest on all transactions will be scrutinized. It should be scrutinized by you as an originator or a processor, and it definitely will be scrutinized by the underwriter. So anytime you have identity of interest, whether it's just in a property flip or even an FHA regular purchase transaction, make sure everything is documented and everybody in the transaction, if there is an identity of interest, you know, somebody who knows somebody else, make sure that that trail is perfectly noted so that it doesn't create issues down the road. You know, a couple things that are good to know. Remember, maximum loan limits are by areas. You can go on to the FHA portal and see that, and we'll show you that website in just a moment. No second homes, no investment properties, except for some rare occasions, and I think I had alluded earlier, FHA 203K loans are going to be opened up, it appears, to investors shortly. Waivers must be run prior to the underwriting decision. Power of attorney, if one of the borrowers is not there, can only be used for closing documents, not the originating documents. We want to make sure that poor borrower that has a power of attorney knows that they're actually buying a house at some point. Mm-hmm. And remember, reasonable closing costs may be paid for by the seller or buyer.
And other things that are good to know, there are various FICO overlays for different FHA programs, specifically some that have subordinate financing attached to it. The appraisers that will be used must be certified residential or certified general and be on FHA's roster to do FHA appraisals. The ones that we order here at Mountain West Financial, we will verify that those features are in place. And correspondents, real estate agents, borrowers, title officers, sellers, anyone connected with the transaction cannot be on the exclusionary list.
So one of the things I had alluded to early on in this, that's a neat part of FHA, is they really position themselves that they pair up very nicely with almost all other down payment assistance programs currently in the market. Mm-hmm. In California, we have CHDAP programs, but we have other bond programs in other states available. There's also city, state, and county programs. You might want to check with your local government agencies to find out if they have a housing program. In most cases, you can send us that program, and we have a affordable housing person that will make sure that that program gets approved on our approved list and then available for future financing. Nonprofit organizations, churches, neighborhood housing services, the Inland Empire, the Good Neighbor Next Door, which is a whole other program. We're probably not going to get into that today, but we do want to tell you that that's another one of HUD's nice programs available to certain segments of the population, to help them with the affordability of their home.
$100 down is a wonderful program.
Well, maybe somebody should call in and check out what that means.
Absolutely. And then other tools that we've mentioned before, there are mortgage limits, but mortgagee letters, HUD handbooks, Mount West Financial bulletins, things that will keep you abreast as to changes with FHA, and then that important HUD ID number that's listed on the screen. Gary, we want them to take that down, don't we?
Well, this should be the number they use every time they do an FHA loan, 742660.
FHA loves the internet. We have a variety of websites here to assist you in your FHA transactions. They are all very helpful. HUD clips, it takes you to mortgagee letters, handbooks, keywords. You want to understand the language and lingo of HUD, and just a lot of sites that will really assist you as you're processing these transactions.
Remember, this is available to you. It'll be on our website, so you can download this, use some of those charts and some of these links as available. I want to let you know that training is very, very near and dear to us. We're very passionate about how much knowledge people should have when operating within the lending industry. We have other Mount West, not only in-person trainings, but we also do webinar and seminar events for special programs, for managing appraisals, program trainings for some of our specialty products like the 203K, the Streamlines, the VAs, the EEMs, USDA, changes and updates in our industry. We have 2 or 3 webinars per year that give you the new regulations and how it's going to impact not only our industry but your career. RESPA loan officer compensation, we have, again, ongoing information that we disseminate out. And like we've mentioned several times, loan processing, the better quality the loan that you create, the better your reputation and the more income you provide, and the better your home ownership experience will be for your borrower.
And we post our quarterly webinar schedule on our website, so feel free to refer to that or contact your account executive or loan officers for continued education via Mount West Financial.
Well, as you know, Mount West Financial, we're here to make homeownership a reality. We love FHA financing. We think our knowledge, our expertise, and our passion for these programs makes a difference. So we really appreciate, from Carla and myself,
Thank you.
We appreciate you taking the time and listening to us. It's been a little over an hour and a half. So like Carla had promised at the beginning of this, for those of you that would like a certification for taking the time to learn a little bit more about FHA, there is a certification test that you may take. Once that's taken, Mountain West staff will get back with you and give you results.
It's very brief, multiple choice, and we wish you good luck in your future transactions, and we look forward to servicing you here at Mountain West. Have a great day.